Good morning. This is Ken Long at Tortoise Capital with a review of the weekend trading reports for November 4th, 2017. The market is in bullish normal conditions. On a long-term basis, looking at NDX 260, we are overbought at 98 out of 100. On a shorter-term basis, using 10-day NDX, we are also barely overbought at 81 out of 100. The threshold here is 80 and then 20 to be oversold. So we're just on the edge of overbought. Price with respect to the 200-day moving average is 6.22%, green bullish, meaning that's still a very strong relationship between price and that long-term average. Slope of the 50 is green bullish 0.53. ADX is strongly bull trending at 28.9, although that is weakened somewhat in the last 2 weeks. The risk index is the 30-period moving average of the VIX divided by the 10. 1.0 is the threshold between risk on and risk off. Current reading 0.961, so we are in risk off. We take that score and compare it to the last 5,000 trading days. Find the average and standard deviation to compute the Z-score, which we call the risk Z. That reading is at minus 0.55 standard deviations below the long-term average. Noticing a slight uptick here in the histogram of the last 90 days of that indicator. You see it smoothly marking changes in the swing term time frame. When that gets below -1 and then upticks, this is a brilliant time to be engaging in long-term swings. When it rolls over and decaying here in the green is a time to be preserving profits, being more restrictive on the new positions that are opened up and more likely to take outsized gains in the face of weakness. When it gets below the red line or below the zero line and into the red, we are actively pursuing short side volatility type targets. When it rolls up and ticks higher, this is actually a good sign, in the same way that when this didn't even get to -1, this was a good swing time. And now we're starting to re-enter that as the market flirts with all-time new highs once more. So that's where we are right now, cautiously optimistic, still prepared to take advantage of intraday volatility, and careful to pick only the most rigorously correct swing patterns here. This should read, these are the current holdings for November. Pardon me, I did not forgot to update this. This is the as of 1 November, the holdings. These are the leaders as indicated by closing prices on Friday in the different portfolios. Next reevaluation on or about 1 December. Theoretical exposure is 90% in ETF2. There was some weakness in Latin America. These are the blended monthly rebalancing portfolio snapshots for ETF 13 and 32. You notice mostly on buy signals with strength overseas in emerging markets in Japan. Treasuries in Latin America showing some weakness, and this is where that weakness in Latin America is starting to appear. So be cautious on Brazil as well. ETF 32, see that again, strengths in technology, China, the BRICS, materials. Some cash signals down here in the shorter term defensive postures. In the sector spiders, technology, aerospace, innovative tech, you see the trend here. Some weakness in biotech started to creep in. And the internet software starting to show some weakness as well. Oil and gas has been horrible, but has a 1 week blip, and so that could be the beginning of a turnaround, or it may be the pause that refreshes and gives an opportunity to resume the downward trend on the short side. So we'll be playing that one on a short-term basis and try to build up some capital in order to fund some longer-term swings. In ETF Max, this is applying the same lens to the larger set of ETFs. In the market health check, We vertical blue lines are 10, 20, and 30 days of look back. Here's 40, 50, 60. This sine wave looking indicator is the slope of the 30-period regression line that right now is starting to decay over the last 15 days. Still at a respectable 0.27. So this is a very favorable 30-day. It's not as steeply up as it was a little bit earlier in this leg. So although this is still good, we're starting to see some weakness creep in with these longer downside tails. The percent price oscillator, which is really the same as the MACD histogram, 10, 30, and 5. Above the zero line, that's good. However, the last crossover was down here and starting to decay, so this looks like it could be running out of steam, and there have been some downward challenges. But for this to cross up above, I would see this as a pocket opportunity, and this is an intermediate low that held at the edge of the river. So all signs point to up, but to be careful and professional in our setups and in our risk management. The previous time we had legs up that crossed down but didn't go to zero and then opened up again. This was the last previous one. And notice there was a nice follow through here. A crossover here gave this leg. This crossover here gave this leg. So that's why we're paying attention to the relationship here on the cutting edge. ETF2 regional report. Latin America went into cash this week, so that puts us at 90 and 10, down a little bit from 100 and 0 in the allocation model. EFA strength at 64 is better than the S&P at 60, so that's the global still outperforming the U.S. Inside the U.S., it's tech, large caps, small caps, mid caps. Two strongest sectors are emerging markets and U.S. tech. Two weakest sectors, small caps and mid caps in the U.S. Energy still lagging. Technology leading the way. Materials starting to look pretty good too at 63. World market model, U.S. is a mixed bag between below and slightly above average. Japan, Asia less Japan, all of the Latin America emerging markets above average. China, South Korea, exceptionally good. Europe remains very strong, and most of the defensive plays are suffering here as the market continues to grind north. The ETF top 30, looking through that ETF2 lens, I look for emerging strength when it goes green on strength, current, and compared to white in its 10-week consistency of strength. It means that it has been above average long term, but is starting to join the upper echelon or upper tier. So that's biotech. China, emerging markets, technology, and more emerging markets here. When it's white on strength but green on consistency, that means it had been an exceptional outperformer in the previous 9 weeks, but now has started to cool off a little bit. So seeing some of that sneaking into the euros and maybe some small caps and EAFE. ETF liquidity sorted by daily dollar volume, and looking at the ATR percentage, the ones in green are both liquid and volatile enough to consider intraday trading and short-term trading. So the VIX, gold miners, Brazil, oil and gas, regional banks. Shifting to the daily report, no signals on channeling and overreaction. Plenty to choose from here on the auto framer, and just only a couple channelings in 551Ws. Johnson & Johnson and Coke would be on my short list. See just how much GE has been underperforming in every measured time frame, and then the outperformance of Intel in the tech sector. Not much to choose from signals here in ATF 30, a handful of auto framers that test out well, and some frog quality numbers looking good. Notice the strength here in the inverse VIX. Metals and mining is still on my short list. It has had some underperformance 10 days, but now has short-term momentum. So I'll be looking at XME. Daily pinch and stretch report. The prices stretched above or below the river are how far they have had an excursion from the middle of the river, or the Bollinger Band mean, which is the 30-period simple moving average. It's measured on a percentage basis and a standard deviation basis. So this 12% stretch above its river in Intel is extraordinary, and this failure of Merck and GE at 3.5 and 4 standard deviations below is extraordinary. And so those are the kinds of things that will either lead to more large momentum moves in that direction or a reversion to the mean. So anything that's highlighted in green or in red are on my short list to be very careful and trade well. The most expanded pinch boxes, these are the ones where you've had 30 days of exceptional directional movement that causes the river to be very wide, and this is an indication of extremely trending. Conversely, the ones that are in the pink are the ones where the river is extremely narrow on a standard deviation basis, and so these are the ones that are being primed for breakout plays. So that's why I like XME right now. Extremely narrow river, and showed some momentum on Friday. The super pinches are ones that are not only extremely pinched on a Z basis, but also have all 4 of their key regression lines tightly compressed. The 10, the 30, the 90, and the 270. So that's a moment when there has been no directional movement, and all of the different time frames are agreeing on what the fair value is, and that makes it right for the beginning of trading behavior to occur as the short-term traders try to start moving it to see if they can get some momentum players to pile on, which may cause longer-term traders to and holders to modify their positions. So this set is among my favorite shorter-term and then swing-term targets. Just trade frames developed for you in the auto framer. Some very nice reward to risk ratios available here. You notice the 16-to-1 in Merck. Nice. Regression line fractal frameworks on the green. The top shelf are the best value plays in my view, the ones that are the most number of ATRs below their long-term fair value, which we treat as the RL270. So you see that Merck, coming up on the radar once more, 8 ATRs away from its long-term fair value. The ones in the red are the ones that have gone past the RL270 the most, and maybe these are the ones that are overheated. So you see a lot of the tech and energy companies, Intel, ExxonMobil, Microsoft, etc. And then these are the leaders and the laggards, if you will, for those 4 different populations of symbols. And then the daily squeezes, these are the ones that I'm looking for one-day pops based on the size of their range stat, which is the reasonable maximum one-day move, compared to how tightly they were compressed on Friday. So this is like a spring action ready to pop. And again, Merck keeps appearing. I guess we need to do as we're told and take a look at Merck real quick. So let's do that. Okay, here you can see Merck, that red Niagara that has found support around 55 has given us a 1, 2, 3 entry here, and starting perhaps to be deep discounted value play with a target at 58.60, closing the gap at 62, with a long-term view of the RL270 as being fair value. Now, it wouldn't surprise me that if we were to triangulate, we might see that the RL270 will begin to decay to respond to this excursion, this maximum adverse excursion, and then value players starting to buy it up towards 59. That's probably where it'll meet, somewhere in the middle over there. We'll be watching for the MACD histogram 10, 30, and 5 to cross over and roll up, and then enter not later than the signal line in blue, entering the it's MACD river here. Notice that when it did that here, it led to a nice recovery. This crossover to the upside led to a nice bump. This one led to a shorter bump. This crossover to the upside led to a nice move. So this is how we stalk that entry using this indicator to fine-tune our RLCO patterns. But this is clearly a multiple Z, a Z3 stretch of enormous proportions, and 16-to-1 on a return to the 10-day high. So I don't expect that to happen, but where's the risk on this one? A couple bucks. And then if it fails, then maybe there's more of this. But is Merck going to zero? I don't think so. So that to me is a pretty low risk idea. All right, that's everything I want to cover today. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry. I got some work to do on getting some Merck orders constructed. Cheers.